Hello and welcome everyone. Thanks a lot for joining us on this Sunday for this month's live stream. It's a very interesting time in the market. So much is happening around us, and I think from also many of our investors, we are facing a lot of questions, and people are seeking understanding of the performance of our outlook and where we think the strategies are going. So in this video I'm going to be talking about the recent events, how the performance has been. Plus we'll be talking about you know the broader macro scenario, what's happening around us and around the world. Plus, we'll be talking about finally the earnings and the sectors where we think we should be investing. I think I think we floated a form also with questions, and you can post out your questions on the chat window, and we'll take it up as it goes. Right? Perfect. So let's begin. I have a quick presentation prepared here. Siddharth, do you think we should wait for a few minutes before we start, or should we start?
We can maybe give it a minute. I am just seeing people coming in.
Okay. All right, so we'll wait a minute or so before we begin. Do let us know in the chat what you guys would want us to talk more about, and if you have any questions. Dinesh Sharma has already asked about SIF. I think this question we get a lot about SIF, and I think see we can't do it as a PMS because SEBI only allows mutual fund houses to do it. We have also talked with our compliance experts and all, so we can't do it. Anyways, let's maybe I'll just present my screen, and we'll just wait for few more people to come in before we start. I think we can start, right, Siddharth?
Yeah, I think we can start now. Yeah.
Okay. All right, guys. So I have a quick presentation prepared for you, like all our previous live sessions. And obviously, there's a lot of uncertainty in the market, a lot of uncertainty in investors' mind. And I think what we'll try to do is explain some of these things in this session, right? So the first thing that we'll start with is, very clearly the performance. I think our strategy has seen underperformance in the last 3 4 months, right? I think 2025 we've seen volatility, and I think more than the volatility, I think this has been a place for us where we have learned quite a lot. So I think 2025 started with us with a stark correction in January, and that correction obviously was very glaring at that point in time. But if you actually look at it, what you would see is that most of the strategies which had risk, strategies which are following momentum, or strategies that were doing active investing or small and mid cap exposure, they all saw correction at that point in time. And obviously we were getting a lot of client requests. We made videos also explaining that, and if you look at some of our previous videos, you would see that there was a level of uncertainty that what's happening from investors as well as from us, from the perspective of trying to explain that. And then I think what we did was that February again was a negative month. We were at par with the benchmark, but March we decided to go defensive, go totally market neutral. We didn't want any risk exposure, and that is where we missed a little bit on the opportunity cost in our fund. So if you look at our performance, our performance did not pick up that much in March compared to rest of the market, and that effect saw a little bit of overflow in April also, and that is very easily explained because we hedged and we went into cash at that point in time. But was this the correct decision? I think that is the learning point, that corrections happen in the market. And if you have conviction in your strategies, that we have absolute conviction in our strategies, right, absolute conviction in what we do, in such a scenario, you should not be doing excessive risk management. So if I look back today, and the stocks that we sold in January and February, and the hedging we did in March, if we had not done that, we would have been in an amazingly better position right now. And that is not to say that risk management is wrong, but I think the lesson here is that you have to have much more conviction in your holdings, and that is why we do it, right? I think any investor also who is coming into any strategy or into the market, should stand true to your conviction, right? I think as investor managers, or sometimes when you talk to consultants, people give you a lot of reassurance. But I think the bigger lesson is that choose the strategies where you have conviction in, and then once you have that convictions, hold true to that conviction, right? And I think we've held on to stocks, but the tactical decision that we took in hedging, that led to some lost opportunity cost, but that was done with a good intention, and we have learned a lot of lessons through that, right? So the big lessons are, letting the conviction in the stocks run strong, align your hedging with understand the risk in hedging. I think we are choosing long term contracts, especially if we're doing options for hedging, that makes more sense. I think another lesson that you will see, that if you follow the market, you would have learned is that good quality stocks, even though they might have been hit because of the illiquidity, right? Some stocks have been hit because of illiquidity. They've seen very strong recovery, which gives you reassurance that quality will hold through any sort of volatility. And obviously being tactical is great, but in such a scenario, when any random day Donald Trump can come and announce anything, or right now we are seeing escalations in India Pakistan also, but there is so uncertainty day on day. For example, last this Friday, everybody was talking about staying out of the market, or sort of taking lesser risk. And with the ceasefire announcement that happened yesterday, I'm not sure how sticky that is, but if that holds true, then you would see a strong recovery. And you could not have predicted that this is going to happen, right? So I think uh, instead of taking very haphazard tactical calls, I think you have to let your stock shine. And then I think one more thing that we have realized is that communication is very, very important, especially for a younger company like us. Uh, because we have only less than 2 years in the PMS, 6 years roughly in existence. People need us to communicate more and tell them what we are doing. And if they don't get that, that becomes a challenge. And i think uh, I think the scale of communication that we saw that happened in this correction was a little bit overwhelming. And I think we have not done the best in terms of communication with clients, and that is something that we really need to learn and execute upon. And that is something that we're doing. We have recently implemented CRM systems in our PMS, where automated, you get access through WhatsApp, through emails, uh, through our channels. We have one place where all client communication is sort of recorded. Plus, we also send across, much more proactive. The idea is that send much more proactive commentary about what we are doing to our clients, right? And then I think another lesson finally is that momentum is an amazing strategy. I think, see, even if you are a value investor, or if you are a quality investor, or any sort of investors, when you take a position or when you exit a position, you're always looking at momentum, right? You're always looking at the price chart. I don't think any investor sort of takes a position without looking at the price levels, right? So momentum is extremely important most of the times, and it also needs some context in terms of what you're doing, right? So that is, I wanted to start with sharing some of the lessons, right? I think that has been a big thing for us during this correction. And next, obviously, if you compare, I was talking about, similar sort of correction that we saw compared to the market, right? So you will see that our strategies were pretty much at par with the comparable momentum strategies or small and mid cap strategies that you could compare. BSE 500, if you go and look at it, it does have a very large cap exposure. There's nothing wrong with that, but obviously, our strategy did not have that much of a large cap exposure. So we saw initial slightly underperformance, and then obviously alpha strategy, which is a high risk one, saw a slightly stucker underperformance. And then March PMS was hedged, so there was some sort of lag. But we believe that our strategies, our stocks are very strong, and we have extreme confidence, and we'll see strong recovery from these levels, right? And I think, in fact, this lesson that we have learned is that seeing correction, seeing such underperformance is the time when you actually have to start building your positions, right? I think another thing people ask us is that obviously all these lessons and all are great, and it's good to talk about it, but are you making any improvements in the strategy? So I would also like to talk about, there's a lot of research that has been done during this correction, and there are a few improvements that we are making in our strategies. See, first thing that we are doing is sort of controlling for liquidity. So many stocks that we held were are and were amazing stocks, right? So I'll give you an example, and this is not a recommendation in any sense, but for example, Swaraj Engines or Kim's Krishna Medical Science Institute, and then you have, for example, eClerx or K FinTech stocks like that, extremely great stocks that you see saw like literally have recovered and actually gone above the December levels now. But due to the liquidity, right, they were slightly illiquid. So the moment a large player starts selling, right, or there is a panic selling that happens, you see a slightly volatile sort of movement in those stocks, right? Now, if that happens, obviously it's not the best experience for the clients, and so I think that is one thing that we've learned, that we have to have stricter liquidity filters, especially in volatile environments, so that it doesn't mean that those illiquid stocks are bad in any way, but that also sort of helps clients have a better experience if you are not facing such painful periods. So we've added enhanced liquidity filters in our strategies. I think another lesson is, avoiding those stocks where you're seeing excessive volumes, excessive volatility. I think that is not the best thing to do in such environments. So we've added, I think very good filters on liquidity and volatility and volume turnover that will help filter out those set of stocks that can, be slightly painful for investors in volatile times. Another thing is risk management discipline. Obviously, we do want to do risk management, but I think a bigger lesson to learn for me and for everybody is to actually choose opportunities, such correction in the market as opportunities instead of selling your stock at those point in time. And another set of improvement that we've been doing across our strategy is enhancing a number of our filters. I think our signals are very good and they remain the same. But how do you filter out the universe to make it much more robust, right? So enhanced quality filters, looking at different quality ratios for the companies, comparing it across the industry, comparing it across their historical averages, and sort of filtering out some good quality stocks. In that way, valuation filters across industry, across history. I think that has been something that we have learned a lot about, looking at some macro indicators, plus making sure that momentum remains the core focus, even if you are investing into quality stocks, right? So you cannot invest into a quality stock if the stock is not showing you good price performance. I think that is something that we actually always have a focus on. So we've done a lot of improvements. I think we'll be sharing a much more detailed review of this, or detailed analysis of this to our active investors soon. And I think that will give more clarity to our investor base, right? So I think we're going to send a much more detailed and data driven sort of analysis on this, in terms of improvements to our clients soon. Now let's come back to the problem at hand, which is the market outlook, right? When we talk about the market outlook, the biggest thing to talk about is the India-Pakistan war. I think that has been the bigger thing on investors' mind, at least for the last couple of weeks. Yesterday, Siddharth, we saw the ceasefire announcement in the evening, and right,
Yeah,
and
we
then
saw the ceasefire, and then there were some potential
yeah,
violations that have happened. So I think
yeah, yeah. So it's
I,
very
bel-
interesting.
I think the MEA is doing some announcement right now also, or maybe around.
Are they? Oh, wow.
I believe so. I think there's some. It came out just a couple of hours back.
Okay.
So maybe after this, we'll listen to what they're saying.
Nice. Okay. Yeah, it would be interesting to know what's happening, because when Donald Trump tweeted, it was like, okay, something, finally, this thing is getting calmed down. But then again, in the night, we saw some tweets and all that, right?
Yeah, yeah.
So it's been an uncertain time for sure. But yeah, I think Siddharth has published a great blog on the India-Pakistan conflict history and how does that impact the market. So I would really encourage people to go to our website, and you will see this blog that Siddharth has written, right, on the India-Pakistan conflict and how does it impact the market. I also picked up a few uh, data points from that particular blog here. So we'll just quickly look over it. I think this is the history of different escalations that have happened between India and Pakistan since 1990s till 2021, right? And you would see this is the movement that our market has seen against during those scenarios, right? So what you would see is the Sensex has on average corrected 7% during those corrections, and it is much more escalated in the Parliament attack, right? And I think during the Pathankot attack in 2016. But I think still during that period, I think Siddharth, you noted that Sensex has done better than the S&P 500. So some of it, in fact, might be cyclical, right? Might be linked to the global movement, right?
Correct. Yeah, yeah. I think the major one that we saw was during 2020, but that's also because COVID is happening around that time. So that's probably why we see a massive correction in Sensex. But largely, it's compared to, let's say, the S&P 500, it's not doing as poorly as we would have thought. In these sort of uncertain and sort of conflict-ridden periods, and
Right,
typically. I'm sure you'll sort of look at it later on as well, but typically the markets tend to sort of do well in the long term as well,
right,
post
right.
scenario.
Very interesting that after Donald Trump has come, he's literally taken us back to 2018-19. And I think that time also there was a lot of tariff uncertainty, and we are going through such a. I think obviously Donald Trump doesn't have a role to play here, but then we had this escalation happening at that point in time also, right?
Correct. Yeah. Quite surprising. I actually didn't know. I forgot about that 2018 and 2019 was in that sort of zone as well. But
Yeah,
yeah, that's an interesting point.
right. And I think again you put down impact of different wars on the market. So again, this is very very interesting. See, you will see that okay, 1 month after, on an average, the market has given 6.3. It's a given a good sort of performance 1 month after, and 3 month and 6 month after the escalations. Typically, the market tends to do well. Obviously, this is all related to the the global markets also. For example, 2008, I think this is not just because of
Correct.
anything, but we're seeing a recovery after 2008, and that might be the case in I'm not sure about 99, but but yeah, if you look at the history of it, it gives you indication that obviously these situations look very, very drastic, but in fact, if you are a smart investor, right? If you really like a few stocks, right, which you were not getting at a good valuation, scenarios like this where you're seeing increased stress in the market are the best time to actually accumulate those stocks, right? And that is not to sort of what do you say?
Downplay the war or anything of
Yeah,
the sort.
not to downplay the situation in any way. Obviously, uh, but yes, if you are sort of, for example, I think I read a book. I also posted about it, right? Uh, uh, Investing like Darwin by Pulak Prasad, where he only invests whenever he sees a downturn in the market, right?
Yeah,
Otherwise, he doesn't invest for a while. And I think that's the same thing that Charlie Munger also does, right? That
yeah,
he
yeah,
sees those opportunities where you see a big downturn and as a lesson or as a opportunity to invest. And that is something that uh, I think that conviction has sort of been really drilled into my brain in this escalation, not just in the war, but in the whole 2025. I think that is a lesson that we have also really, really learned, right?
yeah, yeah. Something to note also is both on this slide and the previous slide is that typically, like if you look at the Kargil war, it's about I think it lasted for a few months. Typically, in that initial period, obviously you'll see a lot of uncertainty, but once the markets sort of tend to get some semblance of a direction of how things are progressing and there's some sort of certainty around it. I think that's the broader point here, which is that once uh, that lack of uncertainty is sort of gone, the markets become more sort of convinced about the fundamentals and the global macro scenario, etc., starts coming into play. Hence, you start seeing a lot of these
Right.
returns
And I
coming.
think another interesting slide that you had put, which I've also added here, is this one, right? That
Yeah,
our market, in fact, has shown strength, right? I think uh, the Karachi Stock Exchange, on the other hand, went through almost a 9.5% correction, right?
yeah, yeah,
But our stock market, in fact, has shown a lot of restraint and strength, right?
yeah,
Which
yeah.
gives you confidence. So,
Okay.
another thing that we've added here is that I think Pakistan, this escalation has led to a full stop on all the trade with Pakistan, right? But I think Pakistan is not our biggest trading partner. We only have a very, very small, I think less than 0.1% of our GDP is in exports to Pakistan, if I'm not wrong, right, sir?
Yeah, I believe so. Yeah,
So I think that's the only bit that would be impacted, which should not have that much of an impact as such. But obviously, there are bigger concerns at play. I think both the nations are large, nuclear powers, and I think that escalation has its own sort of worries, and even for the global market, right? Not just for India. Um, so I think that was a quick analysis on the war. I think this was very nicely done by Siddharth, and this is our read on what the situation is. Next, what we'll do is we'll talk about the broader market, which is the tariff uncertainty as well. If you actually look at it right now, what you would see is the economic uncertainty index, right? In the world right now is at the unprecedented peak, right? It is actually much higher than 2018-19 also, because of what Donald Trump is doing, how China is retaliating to it, what else is happening in the world, right? So I think that is also a big sort of something that makes you cautious, right? Obviously there's a lot of positive news that are coming after the thing. I think India UK have found a free trade agreement. I think India US are negotiating something. I don't know what happens there. Even on China, Donald Trump keeps on talking about renegotiation, resetting the deal and stuff like that. So obviously things will only improve from here, but obviously this could also have larger implications for the United States also, right? I think United States, what they're seeing is a very very stark sort of drop in exports, in some sort of their consumption. They're seeing negative signs, right? The small and medium businesses are being impacted, and that could have some sort of a recessionary impact in the longer term. Even though I think the Fed chairman had said that he's still watching the data, he did not cut rates because he's not very confident on that yet. But I think the bigger worry is that if the United States sort of spins into recession or stagflation, how does that impact the broader market, right? In terms of our trade with the US, I think India only has I think less than 2% of our GDP tied up to trade in the US. And if something gets impacted, that could have, I was reading somewhere, it's not our analysis, but roughly 20 to 40 basis point impact on India's GDP, which would be bad, but it would not be that drastic. In terms of sectors where you have a larger exposure is electronics, gems and jewelry, textiles, pharmaceuticals, machinery, metals, energy, chemicals. Here I think electronics have not been part of the tariff, and even pharmaceuticals are not part of the tariff yet. uh, and I think people were worried about the gems and jewelry industry, even though I think Titan came with an amazing set of results to reassure that, but I'm sure the smaller industry would be hit. Textile also, I think people were exploring that that could have a lot of impact, but I think the FTA with UK has given a lot of confidence to the textile segment also, right? I think India could do much more with the UK on textiles, right? So in terms of the tariff policy, the direct implication on India might be limited, and they might actually not be bad because there's a negotiation going on. But on the broader market, there could be impact on growth for, let's say, the US, and there could be second order effects, right? So for example, I was talking to an analyst about the chemical industry, right? So chemical industry, obviously one thing is that exports to the US go down, and second thing is that if, let's say, China is barred from exporting to the US, it will start dumping that stock into India, right? Or to rest of the world, and India would get impacted from that scenario as well. So there could be second order effects on these policies across different industries. Uh, what you would see is that this is the data of different emerging markets and their exposure to the US, and you will see India has one of the lowest exposure in terms of nominal GDP to the US. So it should not have that drastic of impact, but obviously it will see an impact. And yeah, I think this is something that we covered. Which industries have a lot of exposure? So I think the gems and jewelry industry is the biggest impacted one here. I think pharmaceuticals are not yet in the tariff policy, and then you will have. I think even electronics are not yet in that policy, right? Now let's quickly, having talked about the tariffs, let's talk about what's happening in India in the domestic macros. In terms of, we'll quickly go through some of these indicators that we watch. One thing that we track internally is a fear and greed index, right? So, fear and greed index tells you the amount of euphoria or pessimism that Indian investors have for the Indian market. And what you would see is that fear and greed index, after a very, very long time wait, went positive in April, right? So, this index, in fact, has been negative since. Almost 6 months, and it finally turned positive. There was a sense of greed in the market, and then after this escalation with India and Pakistan, I think it has again turned negative. But yeah, I think still we are not in extreme fear zone. I think there is still a lot of strength that has come back to the market. There are a lot of positive indicators in the economy as well. So one is that the RBI is pushing liquidity into the system. You can see the currency circulation is increasing. RBI has cut rates, and I think there is an anticipation that there might be a couple of more rate cuts that might be coming. The RBI is injecting liquidity through other channels also. So I think that more liquidity into the system sort of boosts the economy, boosts growth in the economy, which is a positive, right? So this is something that we have to understand. Second thing, and this is obviously related to the domestic economy. Second thing is inflation. Inflation is cooling down, right? You can see inflation is at the lowest level in more than a year, which is a positive. And another thing to note here would be that crude prices might stay suppressed. I think that is what the analysts are saying. I think crude prices are going to be sub 60 for the long term. US is increasing the supply of crude, and that might not escalate until unless some geopolitical issues come up. So that is also a positive, because low crude prices will lead to lower inflation, and I think benefits across different industries, right? For example, FMCG industry, and different industries that depend on the crude prices. What you also see is the consumer confidence is finally picking up, right? So this is data published by the RBI, and you can see that after a period of consolidation, consumer confidence has seen an uptick, which is a positive. I think that is something that tells us that the confidence is coming back into the market and among the consumers, which is a positive note. Another positive, big positive note is that FIIs are finally buying into the market, right? So after excessive selling that has happened from October to February, I think March and April, FIIs have turned positive. I think the selling has stopped, and actually you are seeing FIIs are actually buying into small and mid cap stocks. There's a lot of money flowing into the banking sector, and I think they're exiting the IT stocks right now, right? So we're seeing that shift happen, and I think this is a big positive. But yeah, obviously, another interesting point to note is that after a very consistent period of buying, I think FIIs turned seller in the last session, right? In I think on 9th of May. This might be because of the escalation that we saw some sort of a selling happen from the FIIs um, on this Friday, right? But apart from that, you can see there's been a whole period of consistent buying that has been happening from the FIIs. So that was our quick analysis on the domestic macros. Let's talk about the earnings also. I think this is one thing I track. I think Dollars Capital sends me this, which tells you, the number of downgrades versus upgrades. Obviously, there's a lot of earnings that are still to come, but what you will see is that Q4 25 just now is still better than the last quarter, and we've seen some good earnings come out. And I think many companies in our universe, the stocks that we hold, we've seen some very good earnings come out. I think many of them are yet to come, and we are anticipating some good earnings. But right now it looks like this has been a slight uptick just as of now, but I think the data is yet to come. We've seen great earnings come out from ICICI Bank, from HDFC Bank, from Reliance, some of the largest companies. And I think across many of our holdings also, I think there's been some very good earning numbers that have come out. But obviously, everything is not good in the world. I think IT earnings, they've seen a slowdown. You've seen a slowdown across a number of sectors. I think even banking earnings have come good, but there is still uncertainty among the lenders for the next couple of quarters. Chemical industries are uncertain because of all the volatility. Capital markets, there's a lot of uncertainty because of volatility in the market. So I think uncertainty remains, but I can see small bits of positive, and I think that could be one of the it could be one of the turning points when we start seeing some recovery. For example, right now, let's say talking about the IT industry, people are sort of building up that there would be only 2%, 3% growth in their earnings, right? At par with the global growth. They're anticipating a slowdown in global growth. But let's say that slowdown does not happen, right? So in that scenario, the earnings would get upgraded, right? And it would get upgraded by analysts, right? So in case the slowdown in growth does not happen in the global market, that could be a positive for a number of industries coming in the next few quarters. Now, quickly, I think I've talked a lot, but I'll talk about the sectoral outlook also. So this is what we are holding in our factor strategy. You'll see ETF in terms of gold and cash is there. So we have around 5.5, 6% gold in our strategy with some cash. Then I think we do hold a lot of fintech, finance, and banking stocks, right? Apart from that, you would see we have consumer durables, we have pharmaceuticals, we have cement, consumer foods, retail, chemicals, agrochemicals, AC, airlines, fertilizers. But one thing that you would note here is that most of the stocks that we are holding right now have a lot of exposure to the domestic market. I think hardly any companies in our portfolio have a large exposure to the global export market or the global market right now. Even, we do hold a lot of fertilizer, agrochemicals, and stuff like that, which is very interesting. But all of it is domestic focused, right? So we are focusing on these companies. I think there's a lot of potential in the agrochemical space, but we are only holding those companies that cater to the domestic market, because we will see a strong growth in the domestic economy, at least in the chemical demand, right? Similarly, electrical equipment, AC, stuff like that, that we are holding. Consumer durables have a lot of exposure to the Indian market. We have consumer food, we have retail, everything catering to the consumption demand in India. And many analysts do expect that to pick up in the incoming quarters, right? I think consumption is what people are betting on when they come to India. Uh, Here, obviously, we do hold. I think we hold a hotel and we hold a airline company in our portfolio also, somewhere or the other. Those have been impacted a little bit, but it will totally depend on how the escalation of India-Pakistan sort of comes through. I think there's been a big impact on those tourism-linked sectors because of the war. But we'll see how the ceasefire goes to see the broader impact. I think even on the AC front, I think we when we bet on the air conditioners, we are betting on heat, right? That there will be a lot of heat that will lead to growth in AC sales, which is what the anticipation was. But I think there's been good monsoons. We're seeing some impact on those industries, but I think the results have been very amazing. And I think with the PLI schemes and all, there will be a lot of growth across those sectors. So we still invested there. On the other hand, our exposure to agrochemicals and fertilizers, that has seen a good uptake because of the good, I think, starting of the monsoon that came in early. So people expect good rains that could have a good impact on the agrochemical sector. Where do we think that investors should bet on right now? I think manufacturing and capital goods looks really good. I think if you follow the PLI schemes, you will see a lot is changing across different industries. I think on the electronic space, I think on the mobile side, maybe the government has so it's sort of ending that PLI scheme. But across different other electronic segment, right, there are newer PLI schemes that are coming up. For example, I think people are expecting something to come on the compressors in ACs, which is something that India imports a lot. So I think we do have a fair bit of exposure to manufacturing and capital goods across our portfolio, and with China plus one, even Apple shifting to India from China, I think that could be something where we see an uptick. I think financials is looking very interesting. We talked about ICICI, HDFC Bank, very strong numbers. I think very healthy balance sheet plus strong growth. So that would be a great place to actually bet on. And I think right now, the correction that we are seeing in the banking segment, right? We saw, I think ICICI corrected the most yesterday, right, in the last trading session. So that could, in fact, be a good time to start accumulating these stocks because the fundamentals look really, really good. I think we also talked a lot about domestic consumption. I think domestic consumption looks very, very interesting. I think that's what the longer term investors are betting on, that consumption will pick up in India. And I think right now, if you are looking to invest into FMCG, that might actually be a great time to invest, because input costs are going to be limited. Crude prices are going to be low, commodity prices are going to be low, so FMCG will have good input cost plus consumption is expected to pick up. Plus, I think these companies are very strong. You see very high quality names in the FMG segment. They are undervalued, so I think it in fact would be a very good time to pick up a few FMCG names. I think auto also we saw Tata Motor finally come up after quarters of underperformance. So that's been interesting. Even in industrial infrastructure, we do have exposure in some of these stocks. I think defense is a play that is really shining with the war. I think people, defense stocks obviously are very strong stocks. They're winning order books every day. They tend to be slightly high beta or very highly volatile, I would say. But but I think with the war happening, people anticipate the orders will come through more, or the inventory is getting liquidated. So I think those companies will have more activity. I think that could be the reason why they are picking up, but that could definitely be a sector to watch for. But obviously, it will be very very dependent on what happens in terms of ceasefire or not, right? Another thing we talked about is chemicals. In chemicals, we really like domestic focus, specialty, get agrochemical. I think that is working uh, well. I think you're seeing strong demands, amazing numbers coming out from these industries. So we sort of like that as well. So that was our analysis on sectors. If you want to ask us where to stay away from, I would say stay away from maybe IT for a while. And maybe you can stay away from very high beta small caps because that could see a lot of volatility. So that was our analysis on the market. So that let's go over to the questions, right?
Yeah. We've got a few here. I'll just start from the top. So impact from the this is from Mr. Finance Guru. He's asking impact from the recent Indo-Pakistan war slash conflict on markets. What should we be expecting for Monday? Yeah,
First of all, so that we're getting very low views on this live, no?
yeah,
Compared
we've got quite low views compared to our
after
channel.
that, we did send out
I'm
a
not sure. We checked everything. I'm not sure. Do an analysis afterwards.
okay, interesting. So, see, I think in terms of India Pakistan, we've discussed quite a few things, right? But what happens tomorrow? I think if the ceasefire what was followed, I was expecting a bounce back, right?
Yeah.
But I think there is uncertainty that still remains, right? If Pakistan escalates the things and India retaliates, something like that happens. I don't know. That could lead to some pressure also. So I would be, I think 60-70% convinced of a recovery tomorrow.
Okay.
But yeah.
There's a question from Mr. Squidby. He was asking, I think this was in the earlier slide that you shared. How do you decide when to hedge? And what is, from a quant perspective, what's the difference between an excess hedge versus a sufficient hedge? Like, how do you sort of bifurcate that?
Yeah, so see, how do we decide how to hedge? I think we sort of look at, we do it based on the level of risk that is there in the market and the level of drawdown that we're seeing in the strategy, right? I think we modulate based on that, and I'll be very honest that this time in March, the hedging that we did was a little bit ad hoc, right? It was just to just go market neutral. There was so much uncertainty in the market that we went market neutral, and obviously this was a great call, right? The call was great because had we had that hedge in April, we made a ton of money with Donald Trump's tantrums, right?
Yeah.
But unfortunately, our hedges were with mid cap index. It's not around liquidity, so it expired, and that did not play out. But yeah, I think typically the hedges are based on the VIX levels, the amount of risk in the market, and the amount of correction that we're seeing.
Yeah. But so there's a question from Mr. Rahul again on the war. There's a lot of uncertainty. There's a lot of trade wars happening. There's Pakistan-China conflicts as well for the Indian markets. What should they be expecting? Should, like, for instance, is banking a good pick right now as well, or is it too late for them?
So I think banking is a good pick, and like I said, with the correction that we saw in the banks, right?
Mhm.
That might actually be a good time to buy. I think banking is a good long-term pick right now. I think for the next few quarters, banks should do well, especially the private banks. But in the short term, Bank Nifty is consolidating, so good time to buy. But yeah, there's a lot of uncertainty as well. So maybe watch for certain levels before you invest.
Mhm.
But yeah, I think banking is a interesting place to sort of look at right now.
Got it. This is a question from Mr. Mahesh. He's asking, is it the right time to be investing in, let's say, small cap mutual funds for a long horizon, say 8 years, 10 years, etc.?
See, I think very honestly, it's a good time to invest into small cap. I think it's a good time to accumulate that because if you have conviction in those strategies, right? If you think those are good strategies for you to go to, might be a good time to go there. But I would just add that small cap investing is tricky, right?
Yeah,
I think you also have to really really understand your risk profile, right?
yeah,
If for example, what we've seen is that if we have slightly higher risk exposure, and then we see investors really really challenge the strategy, saying what's going wrong, right?
yeah,
I think they are not aligned to the risk expectations. So small and mid caps, you will see corrections in volatile times. So if you are comfortable with that, that's when you invest. But I think it's a good time to invest for the long term.
got it. There's a question here from Bulsology. I think he's got a more quant focused question. He's saying, we typically use growth estimations along with valuation sort of analysis on, let's say, DCF, etc., to get an understanding of what the stock's price is.
Mhm.
But from a quant perspective, as a strategist, is that something that you guys are using, or do you? How do you sort of make the difference in alpha when the markets are in turmoil? There's a lot of sentiments to unravel. There's a lot of emotion involved. A lot of behavioral issues are there. So
Right.
many.
So I think it's a very interesting question. See, we do look at we don't do DCF analysis, but we do look at different estimates of growth, different historical growth, forward-looking growth, growth in different metrics. For example, growth in the margins, growth in the return on equity, a number of trends, and even estimates that analysts who might be doing DCFs are giving us. So we look at a bunch of things to analyze. But yeah, I think your question about behavior and emotions is the one that is the crux right here. That emotions can, you could panic with an amazing stock, right? Like for example, if you for example you're holding a consumer, or let's say a retail stock. I'll just give you an example, or let's say a hospital stock, which where you've seen a lot of good capex has happened. The company really delivers in terms of let's say after the store is launched on the footprint, the company has a very good execution record, and you're seeing consumption uptick still in a volatile scenario because of illiquidity. Right, the stock does not have a lot of volume, and let's say a large investor decides to dump that stock, you might see some correction, right?
Yeah,
And that can lead to some sort of a panic and emotion. And to counter that, what do we do? So I think if you want to counter that in such scenarios, you have to maybe put a limit on liquidity, right? Let's not go into very liquid stocks because you will see a lot of pain and suffering, right? I think
yeah,
that is something that we are sort of implementing. But yeah, I think very astute investors, right? People who work with very long term vision and conviction. For example, again, let's say a Charlie Munger will not be panicked, right?
yeah.
if something like that happens.
Got it. There's a question here from Mr. Again, Squidby's second question here. I think he's asking, he's looking to invest for his children over the next 20 years. Any thoughts on what mutual funds he should pick? One index, one small cap, one mid cap. Is that enough? Should he take a sectoral exposure as well? Some sort of financial planning he advice he wants.
See, I think somebody who's just looking to start, they should go with a mix of large, mid cap, maybe a multi asset, maybe a flexi or a multi cap fund, along with some debt exposure. You can do some of these things through index also, right? So that
Mhm.
would be a good balanced strategy to go with.
Sure. Uh, Dia is asking with respect to the small cases, should they be looking to top up right now? Should they wait given the uncertainty that's there with the war, trade war, etc.?
See, I think you could top up. I cannot tell you exactly if today is the time to top up because it looks like the ceasefire has happened. but does it hold? We'll know, right, by tonight or tomorrow. And I think might be a good time to top up irrespective, because we saw from our analysis that the events like these tend to be short term, right?
Yeah,
And might be a good time to invest, but is it the exact bottom? I think nobody can tell you.
sure. Bulsology has another question. In hedging in these sort of wartime scenarios, what is the best? Do you think gold, shorting the index, building in stock positions, let's say from an FNO perspective? Um, yeah, just sort of any idea on hedging essentially.
Yeah, I think one thing to note here is that when you do investing, right, you have to keep it very separate from your let's say short term trading calls, right?
Hmm.
So when you're taking a investing decision, especially through a fund or through your stocks, you should have a longer term vision before you buy those stocks. So I would not recommend selling when you see volatility, or doing excessive hedging. I think it's always good to have gold in your portfolio in such times. It's always good to have a balanced portfolio. If it has a good balanced mix of small, middle, large, that's great. But so that honestly, in these times, taking a tactical decision is very tricky, right?
Yeah.
Because what will you follow? For example, look at the tariff policy. We did, I think, weeks and weeks of analysis, and I was talking to people just a day before. I was doing such a session then also. Nobody can tell you what Donald. Nobody could have predicted what Donald Trump did, right? Nobody
Yeah.
on earth would have done that. So how will you take that tactical call? Similarly, the geopolitical tension that started, right? It would have been very tough to speculate, right? You could definitely hedge. We also hedged in this scenario, but then nobody could have predicted that it would have ceasefire would reach on the Saturday, right?
Yeah. Yeah. Naturally. So we have the last question here from Mr. Rahul again. He's asking, defense stocks have seen some great returns in the last month or two. Do you think this will continue post the conflict as India looks to sort of maybe even strengthen their um, defense sector?
Yeah, I think I have a interesting answer here. I think defense stocks are good for the long term, because these are strong companies, great companies. They're doing interesting work. They're getting a lot of orders. Indian government has a focus on becoming independent in defense manufacturing, plus even exporting defense equipment. So great opportunity, but short term movement, if it is linked to the escalation that is happening between India and Pakistan, very tough to time it and say that you should be investing right now or not, right?
Yeah.
So I would say long term, it looked like a good thing, even though valuations have picked up quite a bit, right? So I would be expecting a little bit skeptical in taking a position right now. I might wait for a correction if I have to pick up some stock, but it's a good long term opportunity.
Got it. Great. I think that's all the questions that we have, both from the form and the chat from today.
So we have to figure out why we're seeing such a low turnout.
I assumed it's because of the war, maybe. People are maybe still looking at what's happening or something of the sort. But yeah, we will sort of do a deep dive into it as well.
Understood. Okay, perfect. Thanks a lot for everybody who joined, and yeah, we'll see you soon.
Thank you so
Thank you.
much.
Thanks a lot.